So determination of transfer pricing of the specified domestic transaction. The assumption, policies, and the price negotiation. It would be critically affected by a determination of transfer pricing. Documentation gauging the price, which is routine declaration, transparency manner, and being available to public domain. Any other information, data, and documents which will be relevant to the determination of transfer pricing. The above information should be supported by authentic documents. Both the information documents should be contemporaneous. Contemporary should exist on the greatest of the um, oh, contemporaneous and should exist in the specified date, and that is a date on the 1 month prior to the date of filing the return of section 139(1). That is October of the assessment year. Such information in the documents has been kept and maintained in the period of 80 years and the end 8th year from the end of the relevant assessment year. Transfer of income of a non-resident, section 93. Resident and ordinary resident is subject to tax in India, except on the global income, whereas in case of non-resident, income arising and accruing arising outside India would not be taxable in the hands of India as if deemed to be accruing arising in India and does not reside in India. This is in order to reduce the tax liability. The resident Indian may be transferred the ownership of the foreign asset to the non-resident, while continuing to enjoy the benefits of income derived therefore. Section 93 hits such a transaction which is affected with a view of avoiding income tax liability. Such a purpose of section is a non-resident, also including person who is a non-ordinary resident. In order to attract the provision of the section, the following condition to be satisfied, and there should be a transfer of asset. There should be a transfer of any or many. That should be transfer may be made either in alone or in conjunction to the associated process. Conjunction. The transfer of asset is affected in such a manner that the income of the transferred asset became payable non-resident. As a consequence of the transferor neither alone nor in conjunction with the associated operations has acquires a right, a virtual of being, has a power, gets the power to enjoy the income from the transferred asset, whether immediately or in future. Such income of a non-resident transfer would be chargeable to tax in India, and has been the income of a resident tax transfer. Taxing officer is satisfied that avoidance of liability to tax in India for purpose of the transfer. In such a case, the income from the transfer asset should be deemed to be income of a resident transferor and would, according to the taxable in India. Otherwise, if assets are transferred to the body corporate outside India, it is consideration of shares allotted by it to the transferor. The transferor being an assessee under the section in respect of the income of the company derived by it from its assets. Section will not, however, apply to the cases where it shown satisfied with the assessing officer that neither the transfer nor the associate person has had for a purpose or one of the purpose of the avoidance of liability to the taxation. The providing of the satisfaction of assessing officer the transfer of affected by a bona fide commercial purpose and has no intent to avoid tax. Terms meaning associate operation. The operation expression associate operation related to transfer means operation any kind affected by any person in relation to any of the asset transfer, any asset represented whether directly, indirectly, or any of the asset transfer, any income arising from the asset, any asset represented whether directly or indirectly the accumulated of the income arising from such asset. Asset is include property rights of the kind, transfer right to rights including assertion, creation of the right, benefit including payments of kind. For the purpose of section, a person is deemed to have the power to enjoy the income of non-resident. The income of the fact not deal with any person to be calculated at some point in time, ensure that the benefit of the transfer, whether in the form of income or otherwise, receipt of accrual of the income in the operation to increase the value of assets held by the transferor or by the directly or indirectly by benefits. Transfer receives are entitled to receive any income on a benefit out of the incomes or out of the money available for the purpose of a reason for affect their successive effect of the associate operations on that the income and the assets represent that income. A transferor is in the position to obtain for himself or beneficial enjoy by the income by the exercising the power of appointment of power or revocation otherwise with or within the consent of other person. Transfer receives are entitled to receive any of time or any benefit out of the income or out of the money available for the purpose of reason affects the succession and affects the associated operations on the income and assets which represent the income. The transferor is able to control indirectly application of the income of any other manner or other ways. However, determine whether the person has the power to enjoy the income due regard shall be had to be sustainable result and affect the transfer associated operations, all benefit which may at the time acquire to such person as a result of the transfer. Any associated operation must be taken into consideration and irrespective of the nature and form of the benefit. It is to be noted that when the assessee has been charged with tax in respect of the sum deemed to be income under section, the subsequent receipt of the sum by the assessee, whether the incomes or in any other form, shall not be liable to tax in the hands and in this time of receipt. Introduction of specific anti-avoidance measures with respect to the transaction with a person allocated and notified jurisdiction area section 94A. Objective of the anti-avoidance measure is to discourage associate from entering into a transaction with a person located in countries and territories which does not have any effective information exchange mechanism in India. The following are the anti-avoidance measures introduced. The central government is empowered to notify any countries and territory outside India as an NJA notified judicial agency having regarding the lack of effective exchange information in such country and otherwise. Clarification or remove the Cyprus from the list. Removal of Cyprus. Have a list of notified jurisdiction area under the section 94A of Income Tax Act 1961, Circular 15/2017. Cyprus is specified as a notified jurisdiction area (NJA) under section 94A of the Income Tax Act 1961, notified 86/2013 dated 1st November 2013, and said notification has been subject to dissented the notification number now 114 notified October 14 2016 and notified 119 dated 16 2016 as effect of the date of issue of notification. The CBID as a circular clarifying the notification 26 2016 has been rescinded and certified from the date of issue of the such notification, thereby removing Cyprus as a notified jurisdiction area of Cyprus, retrospecting the effect of 1st November 2016. Transaction wherein parties that to a person located in NGA would be deemed to be international transaction, then all the parties to the transaction to be deemed to be associated enterprises. According to all the provisions, transfer pricing to the attracted in the case of such transaction. However, the benefit of permissible variation between the arm's length price and transfer price based on the rate notified by the central government would not be available in respect to the transaction. Any sum credit or receipt from a person located in the NGA and deemed to be an income or receipt of the recipient. It does not explain the satisfaction to the source of such income in the hands of the such person, the hands of the beneficial owner. This person is not a beneficial owner. The rate of TDS in respect of the payments made to a person located in NGA on which the TDS is deducted source. It will be higher rate. The rate specified in the relevant provision of income tax act or the rates in force are 30%. Illustrate A is an Indian company provides a technical service to companies at XYZ Limited located in NJ for consideration of 40 lakhs. It charges 42 lakhs of similar service rendering to PQR Limited, which is not located in NGA. Then PQR is not an associate enterprise. Discuss the tax implication of 94 section 92C in respect of transaction provision technical analysis. Section 1 XYZ located in NGK. Transaction for technical service by an Indian company A would be deemed to be international transaction, and XYZ and A Limited would be deemed to be associate enterprises. Therefore, the provision of transfer price would be attracted in the case. The price of 42 lakhs is charged to a similar service by for PQR Limited. In the independent entity located in the non-NGK country can be taken into consideration for determining the arm's length price of the comparable controlled prices transaction. Since the APLP is more than the transfer pricing, the ALP's 42 lakhs would be considered as an income arising from the international transaction between A and XYZ Limited. We have noted that benefit of permissible variation between the ALP and transfer pricing is not available as for the transaction entering into the entity of NJK. Section illustration 8. Mr. X is a non-resident individual due to receive interest of 5 lakhs on the March 24, 2024 from the notified infrastructure debt fund eligible for exemption in section 1047. He incurred expenditure about 10,000 for earning such income. Assume X is a resident of the NJA. This was the tax implication in section 94A regarding the subsection 115A and 115A. interest income rate by X as a non-resident from a notified infrastructure debt fund, which is subject to a concession rate of tax at 5% and concession rate of tax at 5% on the 115A gross amount of interest income. However, the tax liability of excess respect of such income would be 26,000, that is 5 lakhs plus charges. In the case 194 LB, deduction 5% plus surcharge on interest paid to the fund by non-resident. However, the excess resident of NJA tax would be taxed at 30%. The player's health and execution tax, that is 19 under section 94A. It's not 5% subject to section 194 LA. Section 194 LA. This is the accounts of provision section 994A, which is provide notwithstanding anything constrained to any provision of the act. Whether the person is located in NGA intended to receive any sum or income or amount to be taxed in the deduction under section chapter 7B, the tax shall be deducted in the highest of the following at the rate of time in force at the rate received the relevant provision of the act, the rate of 30%. He can, however, claim refund in the excess tax deducted along with interest. Limitation of the interest reduction sector in certain cases. Reference to a debt over equity as a measure of financial business. Debt and equity are the instrument, though the company is generally financed and capitalized. The manner in which companies capitalize has a major impact on the amount of taxable profit, as the tax laws in the country generally provides for deduction in respect of interest paid or payable while arriving the taxable profit. However, the dividend paid or equity contribution is not deductible. Dividend paid on the equity contribution is not deductible. Therefore, the higher the level of debt in the company, that is, the amount of interest is paid, the lower will be the taxable income. Due to the reason, debt is considered as a more tax-effective method of finance than equity. The multinational company groups is often able to structure their financing agreement to maximize the tax benefits through intergroup financing in the manner that the MSC multinational company is able to claim the excessive deduction of the interest in the higher tax decision, shift the profit to the lower tax decision, resulting in the base erosion of profit sharing. The tax rules to prevent shifting of profits through excessive interest payment. In order to address this issue, tax rules are placed in some countries to fill a ceiling limit of amount of interest paid deducted in the computed of company profit through tax purposes. Such rules are designed to counter cross-border shifting. Counter cross-border shifting of profit. Counter. Profit through the excessive interest payment, which is subjected to protection of the country's tax base. Relevant action plans in BEPs under the initiative of G20 countries, Organization of Economic Cooperation Development. Organization of Economic Cooperation Development is a base erosion and profit shifting. EPP is projected to help take over the issue of base erosion and profit shifting by the excessive interest reduction from the multinational enterprises, and action plan for recommending certain measures in the final report. Insertion of certain provision of income tax in 1961, the line of BEPS, that is base erosion profit shifting action plan for. Section 94B has accordingly has inserted income tax act 1961 in the line with the recommendation of OECD, that is Organization in Economic Cooperations and Development, and BB base erosion profit sharing plan for based on the interest expenses claimed by the entity on the loan borrowed from the associate enterprises shall not be deductible in the computation of income tax under the profit and gains of the business profit to the extent that is arises in excess interest. Excess interest that shall means total interest paid or payable excess of 30% of the earning. 30% of earning of the before taxes, interest, taxes, depreciation, and amortization of the borrowing of the previous year, and the interest paid or payable in associate enterprise of the previous year, whichever is less. The total interest paid or payable interpreted in the interest paid or payable to non-trusted associate enterprises as per the intent expressing of section 94B, and also the explanatory memorandum to the finance bill 2017. Acceptability. The provision shall be applicable to an Indian company or a permanent establishment of an foreign company in India. Being a borrowing who incurred expenditure by way of interest or similar nature in respect of any form or debts issued by a non-resident for associate enterprises for the borrowings. However, the provision of the section, which is applicable only when the expenditure of the V or a similar such exceeds 1 crore in respect of some form of debt issued by a non-resident being an associate enterprise such borrowers. Meaning of it, any loan, financial instruments, financial lease, financial derivatives, or any other arrangement that gives rise to interest. This counter financial charge is status deductible in the computation of the income chargeable section, profit and gain of profit and gains of business profession. Provision of guarantees and deposit matching the amount of deemed to be debts issued where a debt is issued by a lender which is not associated by the associate enterprises, either providing implicit or explicit guarantee to such a lender, or deposit is coordinated with matching the amount fund, providing implicit explicit guarantee to such a lender. Deposits are coordinating a matching amount of funds with the lenders. The debt shall be deemed to have an issue of associate enterprises. Carry forward of excess interest. The disallowing interest expenses can be carried forward up to 8 assessment years immediately succeeding of the assessment year, for which disallowance is first made and claimed to be deducted against the income computed against head profit and gains of business profit and gain of business or profession to the extent maximum allowed in income expenditure. Business excluded under the applicability of provision section 494B. The following to be excluded from the applicability of provision of section. An Indian company or permanent establishment of foreign company which is engaged in the business of banking and insurance. Such a class of business of financial companies as may be notified by central government. Interest paid in the respect of debt issued by the lender and the permanent establishment of India of a non-resident being in person engaged in the business of banking. Meaning of a non-banking financial company. A non-banking financial company means a financial company instituted in India. Non-banking institute which is a company which has in principal plans of receiving deposits under the scheme or arrange or any of them man or lending any purpose. Such as the non-banking institution or class of such institution as may be notified by the bank with the previous approval of the central government. A limitation of interest reduction section 94B summary. It is a borrower or an Indian company or a permanent establishment of a foreign company. Yes or no? If yes, it is a borrowing of a borrower, a company, bank or insurance company. Yes, then section 94 would not be applied. If no, it's a lender of a permanent establishment in India, if a non-resident engaged in the business of banking, then yes, section 94B would be not applying. Does not and then resident engagement no. And does the interest paid to a non-resident and associate enterprise exceeding 1 crore? Yes. And then no, 94 would not apply. Yes, interest excess interest is not allowed as a deduction, and disallowed interest can be carried forward for 8 assessment year deduction under BGPP income to the extent of maximum allowable interest expenses. Meaning of excess interest. Interest paid or payable on a non-resident enterprises in excess of 30% of earning business interest or dividend book interest taxable DA. Earning before interest, taxes, depreciation, amortization. Earning before interest, taxes, depreciation, amortization. Earning before interest, taxes, depreciation, and amortization. Interest paid or payable to a total interest paid or payable may be interpreted on the interest paid or payable to non-resident associate enterprise as may be the intended expression in section 94B, or also explanatory momentum of financial bill to 17. Section 9. The IND Limited, an Indian company, has borrowed 90 crores on 1st of October April 2013 from the TV as a company incorporated in London as an interest at 10% per annum. The loan is repayable 90 crores, 10%, 9 crores. Repayable over the period of 5 years. However, the loan is guaranteed by the MTTY incorporated in UK. And net profit of this company is 11 crores after debiting interest, depreciation, or 5 crores income tax. So 5, 11, 15, 20. Calculate the amount of interest allowed to claim. So out of the 30%, 6 crores, 9 crores, 3 crores. That's if an Indian company. Any company being in borrower incurs any expenditure by way of interest in respect of any debt issued by a non-resident associate enterprises, and such income as an interest exceed 1 crore rupees, then the interest Interest paid or payable by such as Indian company exists 30% of the earning before tax, before taxes, before interest, before depreciation, and before amortization, or interest paid or payable to the associate enterprises, whichever is low, shall not be allowed to be deducted in section 94B. Further, there is a debt issued by the lender which is not associate enterprise, but the associate enterprise either provides an explicit guarantee to such lenders or deposits or a corresponding and matching amount of fund with the lender. That the debt shall be deemed to be have issued by the associate enterprise. The limitation of interest reduction is applicable. In the present case, since the TB holds 40% of voting power, that is more than 26% of the voting power is both ND Limited and MST by NSE. ND Limited and MST is deemed to be associate enterprises. Since the loan is 90 crores and ND Limited Indian company and the MST is guaranteed by the Mrs. T by Limited, associate enterprises of ND Limited, such a debt shall be deemed to have been issued by an associate enterprises and interest payable by the TEM shall be considered to be in purpose of limitation of interest under section 44B. The computation of interest to be allowed as per section 494B and a computation of income under the head profit and gain of business or profession under limited. Net profit is 11 crores. Already interest pay 9 crores plus depreciation 5 plus interest. So 29 crores. Interest payable 9 crores. So total reduction 9 crores minus total interest payable in excess of 30% of that is 30% is 9 crores minus 29 into 30% 30 lakhs interest payment, whichever interest disallowed as section, whichever is 30 lakhs. The interest allowable and reduction of 8.7 lakhs. Okay. The relevance of interest of 30 lakhs will be carried forward in subsequent years and it will be allowed to be reduction under the profit and gains. It is extended to be allowable interest expenditure section 94B. Fundamental law of BEPS. After studying this chapter, you will be able to gain the broad understanding of concept of base, erosion, and profit shifting, appropriate significant in the action plan of BEPS, and comprehend and appreciate the provision incorporated in the India tax liability, Indian tax laws in line with the different action plan BEPS. Background implication globalization. The globalization is a beneficial of domestic economies, boosting the trade and increasing the foreign direct investment in many countries. To restrict the movement of the capital and labor, shift of the manufacturing based on a high cost and low cost location, the gradually removal from the trade barriers, technology and telecommunication development, and ever increasing the importance of managing risk and developing and protecting exploiting intellectual property, and had an important impact on the way of cross-border activities take place. This way, the accelerated growth created jobs and fostering innovation. And globalization is not a new, but the pace of integration of national economics and market has increased substantially in recent years. It has significant impact on the country's corporate and income tax regimes. Growth of multinational companies and consequent tax erosions. By way of 1920, in the pursuit of the First World War, the League of Nations recognized that interaction with domestic tax agreements will lead to double taxation, adverse effect on the growth and global prosperity. Globally, countries concord the need of elimination of double taxation. The need to achieve is a basis of accepting international laws and a clear perspective of the predictability, giving the certainly both the governments and business international tax laws, thereby a pillar of facilitating the development of global economy. This economy international also became more globally integrated. Multinational enterprises (MNE) or represent a significant proportion of the global GDP, also increasing the significance of the service component of the economy and double digital products which was delivered over internet has made it such easier business locate many productive work activities in geographic location that is distinct from the physical location of the consumers. These developments have been accumulated by the increasing sophistication of tax planners and identifying erosion of legal arbitrage opportunity and boundaries of acceptable tax planning, thus encountering M&Es minimizing a tax burden by restoring the aggressive tax planning. Adverse effect of BEPs, base erosion and profit shifting. I've been tax planning strategy to exploit gaps and mismatches of tax rules to make the profit disappear, and tax purpose are to shift the profits to location where there is a little or no real activities but the taxes are low, resulting to the result of no overall corporate taxes being made. This is because a crucial issue of since the government has been copy with the less revenue and higher cost to ensure compliance. Moreover, BPS understand the integrity of the tax systems. As an reporting low corporation tax is considered as unfair. The developing countries' lack of tax revenues lead to significant underfunding of public investment and would be for the foster economic growth. Further, the tax law permits business to reduce the tax burden by shifting the income away from the jurisdiction where the income produced producing activities are conducted. Other taxpayers, especially individual taxpayers in the jurisdiction, bears a greater share of burden. This gives a rise to the tax fairness, ensuring an accountants of in tax individual having a behavior of a higher tax burden. Also, enterprises that operates only in domestic market, including a family-owned business or a new innovation business, have been has difficulty competing with the M&E, but have the ability to shift this profit across the border to avoid the reduction of tax. Fair compensation only by the restoration of induced by the BEPS. Need for international collaboration to protect tax sovereignty by the countries. Taxation is a core of business sovereignty, but the interaction of the domestic law, tax laws with the tax laws in other countries at certain cases of leading to gaps and frictions. While developing a domestic tax laws, sovereign state may be adequate taken into consideration. The effect of other country laws, the interaction of separate set of domestic laws and enforcing by sovereign countries causing friction, including potential double taxation for corporations and operating in such many countries. It is also the gaps because in corporate incomes are untaxed both the countries of source and the countries of residency are taxed only in the normal rates. In domestic context, the coherent in general achieved through principal matching, a payment that is deducted by the payers in the usually taxed in the hands of the recipient. Unless explicitly exempted, there is no similar principle of concurrent at international level, which leaves a considerable scope of arbitrage of taxpayers. The sovereign states have united to ensure coherence in narrow field, namely to prevent the double taxation, the BEPs, base erosion, and profit shifting relates to primary to instance when the interaction of different tax rules and tax systems leads to double taxation, non-taxation. It is related to arrangement that achieves a no or low taxation, shifting some profits away from the jurisdiction where the activities created more profits take place. The international standards have tried to reduce the frictions of manner of respect of tax sovereignty. However, the gap still remains. Therefore, there is no need of countries to collaborate on the tax matter so that they are able to get their due share of taxes. The sovereign of base erosion and profit shifting. The background of said above repercussion of the potential financial crisis 2009 in G20 countries, shifting the focus of center in the international financial system. The G20 mandated the OECD addresses the issue of tax avoidance. In light of this, February 2016, OECD published a report on addressing base erosion profit shifting and iterating the need of analyzing a tax issuing a tax base erosion and shifting profit shifting of global corporations. The OECD follow up with the publishing draft action plan on the base erosion and profit shifting for a BEP's action plan in July 2013. With the comes with the final fruition of October 2015, the BEP's action plan identified that 15 actions to be addressed in the base erosion and profit shifting in a comprehensive manner to set the deadlines or to implicate these actions. The action plans are structured along the three fundamental pillars, that is, introducing the coherence of domestic rules that after the cross-border activities, reinforcing substance required to existing international standards, align with the taxation at the location, the value creation economic activities, improving transparency, tax certainty, brief classification of various action plans based on the fundamental pillars of case. And BEP's action to objective, coherence, substance, transparency, horizontal. Coherence. Action 2. Action horizontal is a digital economy and an action 1. Action 2. Coherence. Neutralize the effect of hybrid mismatch arrangement. Action 3. Strengthen the CFC rules. Cash flow system rules. Action 4. Limit interest deductibility. Action 5 substance. First component preferential tax regimes. Action 5. To component exchange of information on tax rulings. Action 6. Prevent treaty abuse. Action 7. Prevent the artificial avoidance of promoter style statements. Action 8. To action 10. Aligning transfer pricing outcomes with the value creation, intangibles, risk and capitals, and other high risk transaction. Action 11. Data analysis. Action 12. Mandate disclosure rules. Action 13. Re examine transfer pricing documentation. Action 14. Dispute resolution. Action 15. Multilateral instrument. These are the 15 actions. Coherent, substance, transparency. Coherent. Domestic tax. Domestic tax payment to one person result in income reduction by the recipient. International coherent of corporate income taxation. The prerequisite of the complaint with a standard that prevents double taxation with a new set of transaction designed to avoid double taxation on deduction substance. The present tax law must be modified to align the tax substance. Domestic and international tax should be ideally related to both incomes and economic activities. Since the times, the tax treaties and transfer pricing facilities and separate taxable profit from the value creation, such as the shell companies that have little and no economic substance. Concentration of a area of transfer pricing should be addressed with the relevant system. These areas include return relevant to the overcapitalism, risk and intangible assets. Specific rules either within or beyond the arm's length principles may be required to be purpose. Transparency, greater transparency and improved data. The prerequisite of evaluate the impact of magnitude of base erosion and profit shifting. Taxpayers should report the aggressive tax planning arrangement and rules about transfer pricing documentation and breaking down the information on a country by country basis, assign government risk, identify the risk areas and focus on the audit strategies. Making dispute resolution mechanism more effective, they're providing business with the greatest certainty and predictability. The BEPS measures range from new minimum standards to revising the pre-existing international standards to common approaches with the facilitating of coverage in national use and guidance to drawing the best practices. An unprecedented amount of interest and participation has been witnessed in OECD with more than six countries. Both the OECD members and G20 countries being directly involved as part of technical groups developing a coherent international tax regime and including a financial framework of base erosion, profit shifting works to ensure the international tax frameworks to Yemen international enterprises remain relevant to date or further. Therefore, the promoting economic efficiency and global welfare it is to ensure that government continue to effectively raise revenue not only to traditional but also the digital business but also both direct tax and indirect tax purposes. A summary explanation statement indicates the level of potential commitment of OECD's G20s and other states involved in 2015 works to the various reports. The OECD and literally the following terms to indicate the component and various participation countries. New minimum standards. A new minimum standards implies applications of a new rule to implement on all states since no implications may result in negative spillover including adverse impact of competitiveness other countries. Each of the four base erosion and profit shifting minimum standards, namely Action 5, 6, 13, 14, subject to peer review in order to ensure that timely and accurate implementation and safeguard of level playing field. All members of including framework of BPU should commit the implementation of minimum standards and commit the participation of peer review. A reserve of standard which already exists. Existing standards will be updated and will be implemented but the relevant of all the BEPS participants and have endorsed the underlying standards of tax rating, principal pricing and best practice. The best practice is not standard but an optional recommendation for states to follow. The guidance based on the best practices will subject to the countries proposing to act on the areas of mandated disclosure, initiating controlled financial companies. Action Plan 1 Addressing the challenges of digital economy. Digital economy, dissolving the link between prime income, productivity activities, and physical location. At present, in the digital domain, a business may be conducted without regard of national borders and may disclose the link between income, productivity, activity, and specific location. Hence, the business as a business in a digital domain does not actually occur in any physical location, but instead taking place in the cyberspace. The person carrying out the business as a digital domain could be located anywhere in the world. Entrepreneurs across the world has a quick to evaluate their business to take advantages of the changes. It has also been possible for the business to conduct themselves the way that does not exist earlier and give rise to new business models, and they may rely on the digital and telecommunication networks. So it does not require the physical presence and derives in substantial value from the data collected and transmitted over such networks. Given the rise of e-commerce, the entire digital economy has been emerged in the last decade. Since there is a component of intangibility attached of digital model of business, tax authorities often face challenge rightly bringing tax to profit earned from the digital business. To address the same, yeah, first, the action plan now based erosion and profit shifting project to develop the OECD, which outlines a method of principle based on the physical and digital application to be taxed as per. Before the same, the physical location of the service of the digital business will consider the established tax jurisdiction in which the profit of the digital business would be taxed. In the observation, the service were therefore placed in the tax efficient jurisdiction, even though the main income generated customs would form were from other jurisdiction. Taxation issuing e-commerce. New business models under the Industrial Revolution 4.0 were creating new tax challenges since international tax systems are designed during 20th century. The remaining architecture are incapable with the modern day business dynamics. Daily taxation issues relating to digitalization. It is difficult to characterize the nature of payment and establish a nexus of link between taxable transaction activity and taxation jurisdiction. Difficulty location of a transaction activity identifying the taxpayers of the income tax purpose. A digital business where challenges of physical presence based on the permit establishment rules. The permit establishment implies or the remain of a view of a new economy. The fundamental PE is a component developed by the old economy. The place of business location permanency must be concealed with a new or digital right. The OECD recommendation section action plan one of a BEPUS project. The OECD's recommendation several options to tackle the direct tax challenges in this include modifying the existing permit establishment PE rules. It provides whether the enterprise are engaged in a fully dematerialized digital activities and would consistent PE. If it maintains and signifies digital presence in another country and virtually free places of business PE and the concept of PE. The creation of PE is when the enterprise remains a website and servers in another enterprises located in jurisdiction and carried out the business through the website. Imposition of final withhold of tax. Certain payments of digital goods or service provided by the foreign e-commerce providers. Impositions of equalization relies on the consideration of where certain digital transactions received by a non-resident from a resident or former non-resident through the promote establishment under rather contraction states. Taking into consideration of the potential new digital economy and rapidly evolving nature of business operations, it has become necessary to address challenges that terms taxation in the digital transaction. The OECD BEPS 2.0 consensus-based solution for tax challenges arising out of the digitalization. In 2015, Action 1 report provided the option to safeguard against the base erosion and profit shifting account of digitalization. However, it does not provide any recommendation or left it discourage in the countries to resort these measures and part of the domestic law. The report also indicates that it's agreed between the members to continue monitoring developments related to the digital economy, which further reports the delivery of October 2021. After the delivery of the interim report of March 2018, an inclusive framework delivered a blueprint report October 2022 include a concrete proposal framework for two complementary pillars. Pillar 1, Pillar 2. Pillar 1 reallocation of profit and revised nexus rules and global anti-base erosion mechanism minimum tax. The pillar this reallocation of profit and revised nexus rules. This pillar explores the solution for determining whether tax should be paid for a new business models and what basis nexus. We shall ask what portion of profit could or should be taxed on the jurisdiction where the clients or nexus uses are located. A profit allocation. Pillar 2 Global Anti-Base Erosion Mechanism Minimum Tax. This pillar explores the design of a system to ensure multinational enterprises pay a minimum level of tax. The pillar is to intended to address the remaining issues identified by OECD G20 BEPS initiative by providing countries with the new tools to protect their tax base and profit shifting to jurisdiction which taxes these profits are below the minimum rate. The Pillar 2 model rules. This has been designed to make the such accumulated to diverse range of tax pillars, including different tax consolidation rules, income allocation, the entity classified rules, which as well as specific in business structures such as joint ventures and minority interests, as maybe on the specific provision of the Pillar 2 model rules will not apply to all the jurisdiction and each individual in scope M&E. Taxpayers that either have no foreign presence or that has no euro 750 million in consolidation revenue is not a scope of the model rules. In addition, the Pillar 2 rule does not apply to government entities, international organization or non-profit organization, preserving domestic tax exemption for sovereign, non-profit and charitable entities. Nor do they apply to entities that meet some definition of pension, investment or real estate fund. Preserving widely shared tax policy publicly are not wisely to add the additional layer of taxation between the investment and the investor. These entities are excluded or even in the M&E groups the control remain subject to rules. Taxpayers scope of the rules are calculate their effective tax rates and the jurisdiction where they operate and pay top up tax in the and difference between the income and the effective tax rate per jurisdiction at is 15% minimum tax. As a result of the top-up tax is generally charged in the jurisdiction of ultimate parent of the multinational entity. Yeah, DE minimum exclusive, affecting whether it's a relative small portion of revenue income and jurisdiction. The Pillar 2 models is also contemplate the possibility of jurisdiction GAURISDICTIONS to introduce a non-domestic premium top-up tax based on the global mechanism. This eliminates or to least full credential against a liability of a global, thereby preserving the jurisdiction of primary rights of taxation over the over income. Indian income tax regime. The concept of the significant economic presence, the SEP, which is similar to the virtual fixed place of PEs and recommendation of 2015. The BEP's action plan would report has introduced Income Tax Act 1961 and explanation 2EF section 911. The significant economic presence of a non-resident in India shall also be constitute business connection in India. Significant economic presence means nature of transaction and conditions. In the region of the any region aspect of any goods, services, or property carried out by a non-resident within any portion in India, including provision of download of data software in India. Condition: the aggregate of payment arising from such transaction or transaction during a previous year should be excess 2 crore rupees. Systematic, continuous consolidation, business activities, or engaging or interaction with the user in India. The number of users should be at least 3 lakhs. Further, above transaction activities shall constitute significant economic presence in India, whether or not the agreement such transactions or activities entered in India, or non-resident has a residency or place in business or India, and non-resident render service in India. However, where the business connections is established by a reason for a specific significant economic presence in India, only such of the income as attributable to the transaction and activities referred to one and A and B should be deemed to be accrued and arise in India. Insertion of Chapter 8 of Finance Act 2016 and equalization levy in addressing two challenges. In order to address the challenges of digital economy, Chapter 8 of Finance Act 2016, the laid and levy provides an equalization levy 6% in the amount of consideration for specific services received or received by a non-resident non having permanent establishment in India from a resident in India who carries out business or profession from the non-resident having a permanent establishment in India. This provision is provided under Section 165 of Finance Act 2016, meaning scope of service, online advertisement, or a provision of digital advertisement space or any other facility or services for purpose of online advertisement. Specific service also include any of services notified by central government. Further, in order to reduce the burden of small players in digital domain, it is also provided that no such levy shall be made if some aggregate amount consideration of specific service receivable by a non-resident from a person resident in India from a non-resident having a permanent establishment in India does not exceed 1 lakh in the previous year. In Section 165A of Finance Act 2016, the equivalence levy 2% will be chargeable on the amount of consideration received or received by an e-commerce operator from an e-commerce supplier or service made or provided facilitated by it. A person resident in India or a non-resident in the following specific circumstances. The sale of advertisement, which targets a customer who is resident in India, a consumer who accesses the advertisement through internet protocol address location in India, or a sale of data collection of a person who is resident in India from the person who uses internet protocol address IP to locate in India to a person who buys a goods or service both using IP addresses located in India. However, the equalization levy would not be chargeable. Where the e-commerce operates, makes and provides a facility e-commerce supplies or service from a permanent establishment in India, and such e-commerce supplies or service is effectively connected with a permanent establishment in India. Where this equalization levy would be legal specific service under Section 165. Sales and turnover cross received in this case of e-commerce operator from the e-commerce supplies or service made or provided facilities less than 2 crores during the previous year. However, the consideration received or receivable by from a specified service from an e-commerce supplies or service would not be include consideration, which is taxable or royalty or fees to be technical service in India under the Income Tax Act 61 right to the double tax avoidance agreement notified by central government under Section 1990. Applicability of mechanism equalization leave has been discussed in the Chapter 11, Taxation and Double Taxation. Action to neutralize the effect of hybrid mismatch arrangement. Before understanding the action to recommend, we should understand the hybrid mismatches. Hybrid mismatch arrangement meaning hybrid mismatch arrangement of exploits a difference in tax treatment of an entity or instrument under the laws of two or more jurisdiction to achieve double non-taxation. And the hybrid mismatch arrangements are sometimes used to achieve unintended double non-taxation or long-term tax deferral in one or more of the following ways. Creation of hybrid mismatch arrangement. Generation production without corresponding income illusion. Mismatch of foreign tax credit. Participation exemption regimes. Creation of two reductions for a single borrower. A specific country's law that allow taxpayers to opt for tax treatment to certain domestic and foreign entities and aid hybrid mismatch. They cannot easy to find out which countries has a high tax revenue since the law of each country involved has been complete. However, there is a reduction of the overall tax paid of all parties involved as a whole, which ultimately has adverse effect on a competition, economic, effective, transparency, and fairness. Recommendation general amendments as follows. A rule identifying transparency to entities where non-resident investors are residents countries treat to entities in opaque. Example, let us X Limited as a parent company of X country X indirectly holds Y company, an operating company of in a country Y. Now, between X company and Y company is a hybrid entity that is treated transparent or disregarded from the country X tax purpose and non-transparent of a country Y for purpose of X holds almost all equity interests of the hybrid entity, which is a turn holds almost all equity of Y company. The hybrid entity borrows money from the third party, then loan is used to invest in the Y company, and or buy the shares of Y company from the either another company or a group of company or an entity. Hybrid entity pays the interest on the loan, except the interest of hybrid entity does not claim any other significant reduction and does not have any significant income. And with country, in respect of the country, why tax purpose, hybrid entity is subject to corporate income tax. In the interest expenses case used to offset other countries' Y groups companies income under the group Y group tax relief regime. On the other hand, the country X treats a hybrid entity as a transparent or disregarded, with the result of the interest expense are allocated by X Limited with deducts the interest expenses to offset unrelated income. Net effect is no deduction for the same contract obligation to the two different countries. Therefore, the virtue of the rule identifying transparency to the entity which is treated as opaque, the subsequent company countries double taxation avoidance. The rule identifying exemption to credit of foreign underlying tax of dividend that is a deduction of taxpayers. For example, N company is a company resident in a country. N is funded by M. The company resident in the country M with an instrument that qualifies the entity in the country M has a debt in the country N. The payment is made under the instrument should be deducted as an interest expense in N company under the country N tax law. The corresponding receipts are treated as exempt dividend under the tax laws of country N. Consequently, deduction is available under the tax laws of the country N without a corresponding income in country N. Therefore, the virtue of identifying the exemption of credit of foreign underlying tax for dividend, the deduction by the payers exempt such income in the country would not possible. The rule defining the taxpayer of foreign tax credits is withholding tax, where tax is also credited to some other entity. Amendment of CFC and similar regimes attribute local shareholder in the income of tax entities that is treated as a transparent under the local law. Treaties or action plan to recommend a new provision in case of income charged by a transparent entity. As per the new provision, the treaty benefits will not be affordable to any much of this income of the entity as an income. Result of share. Specific or general saving rule is a purpose to the state and can tax on resident entity generally unrestricted by the state. Anti-hybrid rules. The report further issues a series of reduction of domestic non-anti-hybrid rules which would have two stages. The primary rule should deny reductions to prior situation where either these payments will not be included in the recipient ordinary income. The same would be simultaneously deducted by the other entity. Treatment of the branch mismatch 20 years report. The branch mismatch arises when the ordinary rules of allocating incomes and expenditure between the branch and the head office result. Portion of the net income of the taxpayers escaping the charge to taxation in both the country branches and taxation. Unlike hybrid mismatch, which is a result of conflicts of legal treatment entities of instrument, the branch mismatch are the result of difference in the way of branch and the head office of the payments made by to the branch. The 2017 report identify five basic types of branch mismatch arrangement that gives rise to one of the three types of mismatch. Three types of mismatch: double reduction outcomes, indirect reductions, no inclusion outcomes, deduction or no inclusion outcomes. Hmm. Also, the 17 report disclosed specific recommendation for improving the domestic law intended to detect the frequency of branch mismatch and also target branch mismatch rules and adjust the tax consequences of either residence or branch decision in order to neutralize the hybrid mismatch without disturbing any of the other taxes commercial regular outcomes. Action Plan 3 strengthening the control foreign company CFS rules, controlling foreign company rules, shifting the investment incomes or passive incomes or subsidies to low tax, no tax jurisdiction, deferral home country taxation. Under the tax law of several countries, shareholders of the corporations are not taxed on the corporation income unless the income is distributed as a dividend. Therefore, it is common for the publicly traded companies from the foreign subsidiaries to in tax havens as if the probable income to those subsidiaries. Generally, the income settled are mainly investment income, interest and dividends, and passive incomes are rents and loyalties, or swell sales and service income in related services. Tax on the parent country on the tax avoidance include until tax haven countries pay dividends in the shareholder countries. These dividends would be avoided indefinitely by loaning the earning to the shareholder without actually declaring dividend. Many loaning the dividend by loaning the earning to the shareholder without actually declaring dividend. Many countries where a global multinational base has a high tax rate are compared to certain other countries, which uses their low tax rates as a means of attracting inwards investment. As a result, when the dividends are repatriated from those lower tax countries, the recipient generally suffers additional taxes on the profit. However, any companies that have a tendency to leave the profits from and low tax subsidiaries offshore, then such objective to defer the home country's taxation. Obviously, the government were discovered that a multinational levels in the countries kept large amount of profit offshore. In order to address this issue, government various countries has introduced a legislative aim to eliminate the benefit of deferral by currently taxes incomes in the partly countries even when the income has not been repatriated to remedy to another country. These rules are generally referred to as control foreign corporation rules. Control foreign corporation rules addresses base erosion and profit shifting. Control foreign companies rules provide that the actual risk of taxation as a controlled entity. The foreign subsidiaries have striped the base of these countries to despite and in such cases where countries are shifting income from the controlled foreign companies without any say or without any rules. The controlled foreign companies provides opportunity for profit shifting and long-term deferred taxation. The OECD final report does not provide a minimum standard for controlled foreign companies. However, the OECD regards CFA rules being important to tackling the business erosion. Profit shifting has been made series of best practice recommendations relating to building clause and affecting CFA schemes. The major result of the OECD is enabled to provide more than best practice for fundamental disagreement over the policy of CFC regimes. In particular, whether a state has used regimes to protect this other state taxes based on their erosion, earning, stripping. Action plan bore interest reductions and other financial payments. The OECD is concerned multinational groups are able to erode this tax basis, reducing the tax profit and interest and expenses exempted by locating third party debt in high tax countries, using intergroup loans to achieve interest reduction excess the group actual third party interest expenses. Using a related party third party debt to finance the production and exempt the deferred income. Using a third party related party tax interest to perhaps one of the most simple and profit shifting techniques available in international tax planning. Fluidity and fungibility of money makes a relatively simple exercise to adjust a mix of debts and equity in controlled entity. In particular, reduction of the interest expenses gives rise to double non-taxation, both inbound and outbound investment salaries, interest payments, reduction against taxable profits and operating companies. While the interest income is taxed on the comparably low tax rates or not on all the levels of recipient. The BEP's action for plans for development of recommendation for the design of domestic rules to prevent tax-based erosion through the use of interest expenses and other business payments that is economically relevant to the interest. Common approach: linking entities non-interest reduction to the level of economic activities. The mobility and fungibility of money enables multinational groups to achieve favorable tax result by adjusting the amount of debt in a group entity. 2015 report established a common approach where directly links to the entity's net interest reduction to the level of economic activities based on the taxable earnings before the interest, income, and expenses. Depreciation and amortization. This approach includes three elements: fixed ratio rule based on the benchmark net interest and earning before interest, tax, and depreciation and amortization. Group ratio rule. The rule allows entity to deduct more interest expense based on the portion of the worldwide groups. Targeted rules. These rules address specific risks.